What's up, Central Pennsylvania? This week, I'm gonna ask one of the questions I've been getting more and more frequently. We addressed it in a video in the past, but I'm gonna readdress it now. Is the market going to crash? The answer to that, in my opinion, no way. Most people only remember the last economic downturn, which was a recession caused as a direct impact from the housing market and the mortgage guidelines that were in place at that time. Most people don't know this, but let me tell you what happened. Mortgages at that time were written with very loose underwriting and qualifying standards. They would approve almost anybody, and anybody could purchase a home with 100 or even 125% financing. Those loans that were made at that time, you could come in, not verify any income, any assets, as long as you had a decent credit score. And I say decent, I mean a 620, they would give you 100% financing. What happened? People started to default on those loans because they couldn't afford those homes, and hence the last recession, the economic crash that went on in the mortgage industry. Since the mortgage industry has been highly regulated, and every loan that's in place now, people have qualified for based on income, assets, and credit. I think a lot of our friends, family members, when they think about the housing market as it is, they remember that the housing market as it was in 2003, 2004, before the last recession, it was boiling just like the one we have today is. The only difference is the people that got the mortgages today qualified for them. The people that got the mortgages then, maybe they did, maybe they didn't. Let's get into some specifics on the types of loans that were offered at that point. They had loans where you paid only interest payments. They had loans that were negative amortization loans, which meant if you paid the bare minimum payment, the balance that you owed actually went up, not down. They had loans that you had to provide absolutely no income, no job, no asset information. You could finance investment properties with as little as 5% down. And that's what led to that economic issues that we had during that 2007 to 2009 time period. Since Congress, the government has regulated the mortgage industry to some unbelievable level. And now we've hit a new stride where things have become more functional because we've adapted to those changes, so we understand what to expect and we relate to the consumer what they should expect. But it's important that you understand that everybody is in these mortgages now qualified for those mortgages. And that's why I think we're not going to see a huge economic downturn in real estate like we did in the 2007 to 2009 time period. As always, feel free to reach out, YorkPAMortgage.com for any questions, and make it a great week.